I think silver is about to go into the $60, $70 range. I think it'll do it this year. That's not the end of it. That's the acceleration phase I think we're entering. I think gold will advance strongly during that time, but it will be outpaced by silver dramatically. Same with the miners. That if you factor in the continued degradation in the money unit that you're measuring by, we probably have to be $200 just to match those $50 highs in real terms. And don't be surprised by that number either. But no, I think that the technical acceleration is something we could define technically. There will be news stories, no doubt, that come into play, but there will be like ambush news stories that come in after the fact. So if you're not already in and you're waiting for a reason, the reasons will come, but you'll have already missed the move.
Silver's bullish trend remains supported by a broadly weakening U.S. dollar and growing market expectations for a Federal Reserve rate cut in September. These macroeconomic factors are prompting traders to turn to precious metals as a hedge against currency risk and inflationary pressures. As confidence in fiat currencies continues to erode, silver is gaining renewed attention not only for its monetary value, but also for its industrial utility. Market momentum is building, with silver now approaching a technical pivot around $36.30. Traders are watching closely to see whether this level will hold as a launchpad for a breakout toward higher resistance zones. MichaelOliver, a momentum analyst known for his accurate long-term calls, believes this could be just the beginning. He forecasts silver could rise to $60 to $70 this year alone, potentially triggering a much larger acceleration phase. While he remains bullish on gold as well, Oliver expects silver and silver miners to outperform the gold market significantly. One of silver's key supports continues to be robust industrial demand, particularly from sectors such as solar energy and electronics. This consistent demand has helped stabilize prices during brief pullbacks, ensuring that dips are met with strong buying interest. Meanwhile, geopolitical uncertainties, trade policy shifts, and political tensions are prompting investors to increase their exposure to hard assets such as silver as a broader hedge against systemic risks. Oliver also notes that silver's old high of $50, reached in 1980 and again in 2011, was brief and doesn't reflect today's economic conditions. When adjusted for decades of inflation and currency debasement, he argues a more accurate equivalent could be closer to $200 per ounce. As for gold, Oliver refrains from offering a precise technical target due to the extreme level of global uncertainty. However, drawing on historical precedent, particularly the two previous bull markets where gold rose eightfold, he believes a price of $8,000 is within the realm of possibility. Meanwhile, analysts at ANZ observe that while some tactical fund flows have rotated into silver and platinum due to relative valuation gaps, gold remains the top choice for macro and geopolitical protection. They see recent corrections as shallow and temporary, with strong strategic demand expected to drive gold higher into year-end, making any pullback an opportunity to accumulate. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I don't know where it's going, except to say it's no longer going to lead. Our technical assessment is that silver and the gold and silver miners will now move from the back to the front in terms of performance. They have lagged gold on an upside basis, on a percentage gain basis. They've gone up nicely over the last several years, but not as much as gold. So they've underperformed, so to speak. They're technically at the point now of breaking out of that trend of relative underperformance. So when you don't focus on the price of silver, which looks quite good, or the miners, they're quite stout now, but the relative performance to gold, and technically it is breaking out, favoring them. So whenever that happens, it almost always converts into a net price acceleration in all the monetary metals, silver, gold, and the miners, meaning they go up in an arm wrestling manner, and then suddenly when they accelerate versus gold, outperform it, that's usually when price also starts to go berserk. And I think we're there. I think silver's crossed that line. I think it did it early this month, getting up to the high 34s again. There were two highs at 35. Price guys noticed that. We took that out. That's not really that important, but there were some momentum factors that came into play in the upper 34s that said, you're out of here. And since then, we've surged to 37. And right now we're trading, in a range mostly in the weekly closes for the last 4 weeks, mostly above 36, just going to sleep up there, quite firm. I think silver is about to go into the $60, $70 range. I think it'll do it this year. That's not the end of it. That's the acceleration phase I think we're entering. I think gold will advance strongly during that time, but it will be outpaced by silver dramatically. Same with the miners. Where is gold ultimately going? Let's give you some context. I don't know where a technical target is, because the reality we've been talking about is so serious that when it unfolds, it's 52 card pickup in terms of where things might go. But if you go back and look over 50 years of gold's history, you've had a couple bull markets that were both eightfold moves, a bear low to bull high, eightfold, 8 times. Our low was 1,050. And annual momentum turned up shortly after that by our metrics at 1,140, and we've not changed our views since then. But if you go eightfold, you go to $8,000, and that's merely replicating the dimensions of two prior bull markets that existed under far less dangerous dynamic potentials that we are currently in. So 8,000 would merely be doing it again. So you could say, well, 8,000 is a target, but it's really not. It's just a norm. But in that period, I think it's the mama market, but watch silver and the miners. They're the better place to be. And I think the old highs at 50 were phantom anyway. If you look at them closely, they lasted like hours or a few days. They really weren't like living up at 50 for a long time. And they were so long ago that if you factor in continued degradation in the money unit that you're measuring by, we probably have to be $200 just to match those $50 highs in real terms. And don't be surprised by that number either. But no, I think that the technical acceleration is something we could define technically. There will be news stories, no doubt, that come into play, but there will be like ambush news stories that come in after the fact. So if you're not already in and you're waiting for a reason, the reasons will come, but you'll have already missed the move. Many markets do that. You go back and look, there's a lot of base metals over the last few years have gone berserk on the upside, and they fail. But this is a monetary metal too. And a lot of investors fail to remember that. That's why they dumped into silver in early April. We had the drop from 35 to 27.5 in a week or so, most of it in 2.5 days. Gold only flinched a little bit. They dumped on silver thinking, oh, it's part of the economy. No, it is a monetary metal. It is linked to gold. And if you look at long-term history of the price of silver, it doesn't correlate well to the Bloomberg Commodity Index. It correlates well to gold. And it's been lagging gold on a percent basis, but it's been trending with gold. And I think it's just about to go into one of those phases where you can go back and see examples of this in the past, 79, 80, 2010, 2011, where silver just went rampant. It left the earth. And it wasn't due to factors that we've got anything like now. So it's different this time. And I'm not predicting that's the end of the bull. I'm just saying this is the next surge. And beyond that, God, I don't know where we're going. A couple $100 an ounce wouldn't surprise me. It depends on these other realities that are about to unfold in a dark direction.
U.S. stock futures climbed as President Trump's expansive spending bill advanced to the House after narrowly passing through the Senate. Investors appear optimistic about the fiscal stimulus, helping to sustain the market's recent strength. The S&P 500, which had plunged earlier in the year following Trump's announcement of Liberation Day tariffs in April, has since mounted a remarkable rebound. It gained 6.2% in May, marking its best May performance since 1990, and added another 4.6% in June, pushing it to new highs. However, not all analysts are convinced by the rally. MichaelOliver remains skeptical. He argues that while prices have surged, momentum indicators tell a different story, suggesting the market is still fundamentally broken. Oliver refers to the new highs as a teaser, warning investors not to be lured into a false sense of security. He emphasizes that despite the spotlight on equities, assets like gold and silver have outperformed the S&P 500 over the past several years, even though this outperformance remains underappreciated by the broader market. Historically, July has been a strong month for U.S. equities. Over the past decade, the S&P 500 has averaged a return of 3.4% in July, second only to November's average return of 4.2%. While historical trends are no guarantee of future results, the combination of seasonal strength and fiscal optimism has many forecasting continued gains through the remainder of 2025. Still, Oliver's caution serves as a reminder that market rallies fueled by policy or sentiment can be misleading without underlying structural support. In his view, investors may be better served by diversifying into assets with proven long-term resilience, such as precious metals. Let's get back to the interview.
In January, the S&P dropped enough to cause our quarterly momentum of the S&P. It's not the price chart. It's not some short-term momentum metric. It's a fairly long-term metric. Broke structure, meaning if you looked at the momentum chart, you'd say, oh, the bridge on the River Kwai just cracked open. Okay. We had a spill. It didn't get going until late March, April, with some news, which is unfortunate. News is never a good driver. And we had predicted in the middle of that move that the low, a bounce point, We defined it as a bounce point, meaning if you're in puts, you better be careful. Okay, 4,800. It stopped at 48.35 and bounced sharply. That's when Trump said 90-day pause, and since then has crawled incrementally, but ever so steadily, back to the old high. Yesterday and today took it out. We got up to 60, 80 something today. Last I saw, we were dropping back to about 60, 40. So we did take out the high that was seen in February of this year. Okay. We still think, based on momentum, that the market is broken. This rally to a quote new high is a teaser. We do not trust it. We urge people not to trust it. Besides, there are better places to be anyway, and have been for several years. Monetary metals have beat the pants off of the stock market. People don't realize that, but if you do the measurements, you'll see that owning gold 3 years ago beat the S&P handily, not just the last 6 months. Okay. This topping action by the S&P and the NASDAQ very much caused me to have deja vu. Back in 2000, at the dot-com top, we put out a sell report on the first day of January of 2000 and said, get out of the market, it's topping. Sure enough, the market started to drop then, dropped sharply into February, about a 10% drop. But by March, it came back up and produced a new price high. Momentum still said, no, you broke stuff. You're no good. Don't trust me. And it labored all year, well, it labored for the next 6 months anyway, through the summer at, below, and above our point of exit that occurred in January. So it basically went to sleep. Didn't go up a lot more. It went up enough to make a, quote, new high. And it wasn't really until you got into 2001 that all hell broke loose on the downside. That's when the Fed cut rates, by the way, January of 2001. Then the other deja vu. Let's go back to 2007 top. In the close of December 2006, we put out a report and said, likely topping next year. And we put a price range. At that point, we were the 1400s or 1300s, I think, in 2006. We said you go to 1550 to 1600 would be the topping zone. Okay. In May of 2007, the market worked its way back up and got to 1553, I think it was. So got up marginally into our zone, which, by the way, if you go horizontally all the way back to the year 2000, that's exactly where it peaked at the dot-com top. So the price guys see this thing, a peak at 1550 plus, a peak at 1550, and somebody sold it there thinking, oh boy, I'm going to sell the old high. They made a little bit of money because you dropped hard into August. Then what happened? You started to turn, and in mid-September, you're coming back up toward that 1550 level to try to take it out, impress everybody. The Fed cut rates. You goosed the market up about 3 more weeks into October, got to 1575, precisely in the middle of our targeted range, but a new price high. In fact, not only above the May high of that year, but above the 2000 high. So a massive dual price level was taken out. And so what? If you're looking at a price chart, you should do what? Oh boy. Okay. That was it. That was the top. You ooze back down and all hell broke loose over the next year and a half, 2 years. Fed cutting rates all the way down. So now we have a similar situation. You make a high late 24, early 25, most indexes, almost all indexes. The Mag 7 were up there cheering, along with it. You get a sharp drop into April, and you work your way back up, and now in a limited horizon view, you've made new highs. S&P, NASDAQ 100, marginally, like 1% above that high. If you look, however, at the Mag 7, you'll see like only 2 of them are back to their highs. Third one's close, but that means only 3 out of 7 now. Okay. The rest of them don't even look like Mag 7 anymore. Okay. They're the lower half of the last year's range. And then when you go to sectors like commercial real estate, banks aren't making new highs. Dowd Industrials, they're not making new highs. They're not even that close. Healthcare sector looks like hell when you look even at the price chart. I can name more, but the point being that now we're making the new high, and you hear it on CNBC and Fox Business about, oh boy, is a new high. And when you look around, even just at price charts, something's wrong. It's very narrow. Momentum says there's something wrong. Momentum is, in fact, if you looked at a momentum chart and compare it to a price chart, maybe you've got some of those handy. Price looks great because it went up and nipped out a new high. But when you look at momentum, there was a structure, like a floor on momentum that was very clear. It wasn't clear on price. And you broke it, and you're up under the floor right now, incrementally upticking. Meaning, when you got near the floor a few months ago, in fact, the action started to slow to a snail's pace. Very incremental gains every day, 5, 10, 20 S&P points, et cetera, et cetera. And now finally a new high. You're still up under broken momentum trend structures on NASDAQ 100 and the S&P. And you've lost your leadership. Mag 7 aren't Mag 7 anymore. And too many sectors are chuckling at this. And these are sectors that back in 2024 and early this year were up there with the S&P at the high, happy with it. Now suddenly they're not back up there. So even the price charts, if you'll survey the horizon, something's not going on here that should be going on, if in fact the new high means anything.
Every market cycle has its moment of reckoning, and silver may be approaching one, with historic magnitude. The metal's surge is no longer just a reaction to short-term catalysts, but a reflection of more profound structural shifts in currency trust, industrial necessity, and long-term capital positioning. As equities dazzle on the surface of strength, seasoned observers warn of unseen fractures. Meanwhile, silver quietly builds a foundation beneath the noise, potentially preparing for a generational revaluation. Could the quiet ascent of silver signal not just a price breakout, but a broader redefinition of what holds real value in the coming financial era? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.